Hello everyone, I'm Susan Galinsky.
And I'm Denise Grace, and we are the founders of G Squared. So for the best information on how you can have a successful retirement, subscribe to our YouTube channel and hit the notification bell so you can be advised anytime we upload a new video.
So for today's topic, we're going to discuss, do you know the difference between qualified and non-qualified monies, and how important it is to your retirement plan. So before the end of this video, you will have all the facts of how to manage both of those types of money so that your retirement portfolio can be successful. So let's do just a quick history lesson, Denise.
Okay. Well, ERISA, which is the Employee Retirement Income Security Act, invented qualified money. Back in 1974, pretty much all people had back then for retirement were pensions, and even back then companies were cutting back on or eliminating pensions. So ERISA invented the 401k and the IRA, etc. But with this came rules that qualify that money as qualified money. That's where they came up with that term.
Right, qualified money. So what is qualified money? Well, to put it simply, it's pre-tax money. So as Denise mentioned, it's what you put away every week or month into your 401k, your 403b, traditional IRA. Those are all great examples of qualified money. And of course, it has that advantage of growing tax-free until you actually take a withdrawal. So to this point, let's talk a little bit about pay now or pay later when we think about taxes on that pre-tax money.
Of course, you didn't pay the taxes on that money as you socked it away, but the IRS has rules, those rules around qualified money, that dictate how you'll be taxed and when you'll be taxed. So for instance, if you take that money out before age 59 and a half, you're going to have a hefty 10% penalty on any amount that you withdrew. And by the time you turn 72, up to now age 75, depending on when you're born, the IRS dictates how much you have to take out. Those are called required minimum distributions. And they tell you how much you have to take out each year. It's a percentage. They have a table that actually goes up to age 120. So they want to make sure they're going to get every last drop of taxes that they can. So when you put money away in those qualified accounts, you have to be really cognizant of what you're doing and what the tax ramifications are going to be for you later. So let me give you an example of how that might not play out in your favor. I met with a couple of years ago. He had, between the two of them, they had over $2 million in qualified money, and his wife was still contributing to her 403b. So while he's pounding himself on the chest, aren't I a great saver, I literally looked at him and I said, are you nuts? Because take a guess at what his first required minimum distribution would have been. It would have been at least $80,000. So imagine having to pay federal tax and state tax on $80,000 in addition to his pension, in addition to his Social Security, and it would also have put him in a higher Medicare Part B tax bracket. So planning is important. We meet so many people who have the bulk of their money in qualified accounts without thinking about what's going to happen later.
Yes, absolutely. And to look at how complex this really could be, I'm going to put a slide up here, which it shows the traditional IRA flow chart. And you can see there's many conditions. So is how old is the IRA owner, and you have to keep those IRA accounts separate. Is the owner still living? There is such a thing as inherited IRAs, and the rules have changed there. There is multiple, you can't combine them.
What can you combine, what can you not combine?
Right. So it becomes very complex. This is where working with us can be really beneficial to you, because we can look at those scenarios that are specific to your situation and work through where we can minimize the taxation. So to that point, let's talk now a little bit about qualified or non-qualified monies.
Well, non-qualified money, as you can guess, is money that you have already paid taxes on. It could be something as simple as a bank CD, a savings account, or a non-qualified brokerage account. The big difference is, while you don't get a tax deduction when you put that money in, you're putting in after-tax money, and any interest that you earn will be taxed usually in the year in which it was earned. If you have a CD, you're going to get a 1099 from your bank every year, and you'll be paying taxes on that money. Same thing if you have a brokerage account that earns interest, or if you have capital gains on your brokerage account, you're going to get a 1099 and you're going to pay those taxes. But like I mentioned earlier, it's really important to have a mix. Another type of non-qualified money would be a Roth IRA, which has its own rules. And to tell you the truth, because tax rates are lower now than they've ever been,
Right.
and everyone pretty much anticipates tax rates going up in the future, we've been doing a lot of Roth conversions in the last couple of years.
Right.
Because people want to get rid of that tax burden. They don't want that $80,000 tax bill. So, Roth conversions are something that you really might want to consider.
Exactly. And there's another thing that we like that's in our arsenal, and that is non-qualified annuities. And the reason why we like non-qualified annuities is that you can put money in there for the duration of the policy, whether it's 5, 7, 10 years, and that money will continue to grow each year without any taxation. So what you're getting there is the advantages of you're getting interest on interest, and you are delaying the taxes every year that would be due until you actually withdraw the money. So that's a best kept secret out there that a lot of our clients use, and we help them with that all the time.
So if you'd like to see how some of these ideas or concepts might apply to you, click on the link provided below, and let's set up a 5-minute chat just to see how G Squared may be able to help you minimize or mitigate some of those taxes that you've got accruing.
Exactly. And in closing, we want you to know that we truly appreciate you, and we believe that it is important to build relationships beyond investing. Thank you.